Well, good evening and welcome everyone to the CattleFax Trends Plus Cow-Calf webinar. We thank you all for taking some time out of your busy schedules to be with us. We know that in this chaotic world, there's a lot of things going on, and hope that we're able to provide some clarity and a little bit of background information on what we see going on as it pertains to the cattle markets here this evening. So this webinar is sponsored by Elanco, and we appreciate their sponsorship and allowing this webinar to be free for all cow-calf producers here this evening. So just an outline of what we'll be going over this evening. We'll start off with projections as far as the cattle markets go, and then also looking at the protein sectors across the protein landscape and the grain markets as well. We will then hone in on our outlook for the summer and fall calf markets for 2020 in light of all the uncertainty that we're seeing here today. And then we'll dive into some of the results from our recent annual cow-calf survey. And then lastly, we'll hear an overview of some available products from Elanco. And before we get started too, if you have any questions, please enter those in the chat box, and we'll try to save some time at the end to go over any of those that you may have. I'm Patrick Linnell, and I'll be walking you through the first section of this, looking at the market outlook. So clearly the story tonight is COVID. As we look at things, that's clearly the dominant factor that's really shaping cattle markets, or really any market or sector of the economy or the world right now. As we looked at things and we think back to when this pandemic started, I think mainly we were focused on what type of demand disruptions we would see as we went through this. Certainly expecting some degree of supply disruptions. And then, as we well know, now certainly the situation with the production disruptions at the packing plants is clearly the biggest factor impacting markets. And I think then as we continue to make improvements on that front and hopefully become somewhat closer to normal in terms of slaughter and production, we will again kind of turn that focus to the demand disruptions and what that looks like as we get on down the road. So we've clearly seen where this production and the labor restraints at these packing plants has severely been impacted, as we've seen social distancing, we've seen outbreaks at different plants and closures because of that. We did note that the lowest production levels and where that was at its worst point is now behind us in the month of April, and we've seen continued increases in May and seen a very nice return from some of the worst positions that we were in terms of slaughter capacity. But we do recognize that as we look down the road over the next several weeks and in the months ahead, it will take time to get us back to those pre-COVID levels in terms of packing efficiency. Certainly expect that we'll continue to see good progress here directly ahead of us. But as we think about those continued labor restraints and how that will impact us and largely prevent or create an uphill battle in terms of getting production back up to those pre-COVID levels. So as we start off taking a look at the competing protein side of things, taking a look at the poultry side, we certainly saw that there, through the month of April, is where we saw the most significant destruction in terms of production. With the absenteeism and then the plant closures that were there. But as we look on down the road, the more significant factor will probably be the second chart, which shows the number of broiler chicks that are placed on a weekly basis. So you can see that throughout the second quarter, so far, chicks placed are down nearly 6% compared to year-ago levels. So as we look on down the road, we can expect that poultry production will be restrained through the summer months at least. You certainly recognize that the production systems and the biological system of the poultry industry will certainly allow them to come back online and ramp up production a lot quicker as we get into a more normal world, and they recognize that food service demand coming back. But for the time being, we can see less broiler meat being produced than what we would have forecast originally. Similar situation on the hog front. This chart looking at pork production, you can see the massive levels of pork production that the industry was running at through the first quarter of the year. And then COVID hit. We saw production slip to below 60% of maximum industry capacity, nearly offsetting all of that production increase that we saw in the first quarter, evaporated largely over the course of those 6 to 8 weeks. And so as we look down the road, also considering a production system that's a little bit more flexible than us in the cattle world, we can anticipate that as hog producers suffered these backlogs and profitability quickly eroded, that they'll be pulling back the reins to at least some degree on production going forward. We've certainly heard news reports of piglets being destroyed, or simply sows or gilts that were ended up not being bred that would have without this situation. So as we look on down the road, we can anticipate that production will be capped through the second half of the year, somewhere in that level comparable with year-ago levels. Where that ends up, we'll just have to see in terms of how much the hog industry was able to move the needle. But again, less pork production than we would have otherwise forecast. Now, flipping to the cattle side of the equation, what this chart shows is we took our original forecast before these plant disruptions became apparent and compared that to what actually happened. So how many cattle did we back up that we were not able to work through the system that were ready to go? And so this data suggests that as of last week, we've backed up roughly 900,000 head, 2 million head of fed cattle out of feed yards that were intended to go through slaughter. And so as we look going forward, as you follow the red line, which would be kind of factoring in our rough projection on gaining back slaughter capacity here going forward, even though we are gaining slaughter capacity, we're still creating a larger and larger backlog as we're still not able to slaughter through that underlying supply that was intended to go through the packing plants. And so we do anticipate that before this is all said and done, there's very large likelihood that we see somewhere around 1.2, 1.3 million head of cattle backed up, assuming that we can get back to something around a 500,000 head fed kill a week. As you can see on this chart, this shows the weekday USDA fed cattle slaughter. And you can see the pretty steady pace that it ran through the bulk of the first quarter. And you can pretty easily see where these plant disruptions began to take shape, ending up with slaughter down roughly 60% from forecast at its lows. Then, as you can see, we've had a nice recovery in terms of gaining that slaughter capacity back, now up to roughly 75% of capacity. But recognizing that even though we've made significant progress, there's still a long road to hoe as far as gaining that capacity back, and not only ending this backing up of cattle, but beginning to actually work through that surplus that we've created, or that deficit in terms of fed kill. So as we look forward, can anticipate that beef production will remain restrained, likely into the month of June, and then hopefully at that point be getting back towards something that we would recognize as being closer to normal. Again, roughly that 500,000 head per week of fed kill. Now, considering that million head that we've backed up at this point, certainly the glimmer of hope that we do have as we look in terms of working through that backlog of cattle is the fact that placements into feed yards have been down roughly 1 million head year to date compared to last year. So luckily, as we look, there's certainly a placed against hole somewhere out there into the August, Sep-Oc, and somewhat into the November timeframe, and that can potentially allow us to work through that backlog of cattle. But even so, recognizing how many cattle that we've currently already backed up does suggest that even with that hole in terms of that placed against supply, it likely will take us until around the end of the year to work through that backlog of cattle, which will continue to restrain the market until we can work through that supply. So as we came into the year, we were forecasting that fed slaughter would be up roughly 100,000 to 200,000 head compared to year-ago levels for 2020, based on a larger on-feed population and then the cattle that were outside of feed yards as well. And then with this slaughter disruption, we now anticipate that fed slaughter will be down roughly 1 million head compared to a year ago. Now, certainly, there's a lot of moving pieces as far as this goes, and I think it all depends on the ramp up in terms of gaining back that slaughter capacity, and then also where does it plateau? Can we get back to 95%, or is that more an uphill battle and the industry struggles to get beyond 90%? We are optimistic that we can get back to those fuller capacity levels, but recognize that challenge out there. Slaughter will be down anywhere from 500,000 to potentially 1.5 million head this year. Now, as we look in terms of production, the offsetting factor certainly carcass weights. Last week, the last reported steer carcass weights up roughly 41 pounds from year-ago levels, recognizing that we did start off the year, even pre-coronavirus, at some pretty elevated weights. But we recognize that with the backlog of cattle, this trend certainly won't be reversing anytime soon. And we expect that that the cattle will continue to have plenty of weight on them as we add more days than those cattle were intended to. And so, again, this should be somewhat offsetting to the decline in slaughter as we look at beef production on down the road. So we roll it all together, looking across the three proteins, beef, pork, and poultry, in terms of our 2020 production forecast. We adjusted these numbers pretty significantly as all these disruptions unraveled. We now anticipate that beef production will be down somewhere around 0.5 percentage point compared to year-ago levels. Again, as we pull back on slaughter pretty dramatically, but weights in a large way offset a lot of that. Pork production shaved about 1 percentage point off that, recognizing that we've already produced a lot of pork through the first quarter, but then also there was plenty of hogs in the pipeline to begin with. And then the poultry side of things, easily the most flexible, dialed that down to around up 2%, up just less than 2% for the year. Recognizing that as the economy regains its footing, we could see that beginning to rebound as we get towards the end of the year and likely into 2021. So even so, we do anticipate total meat production in the United States to be up roughly 1.3% on an annualized basis. Now, taking a look at the trade front, and this data, the most recent data we have is through March. So clearly before coronavirus began impacting markets so significantly. But exports started off the year on extremely strong footing. As you look at pork, up roughly 40% compared to year-ago levels in the first quarter. Beef, up a solid 10.5%, and broiler exports up around 8% as well. Now, we do anticipate that as we work through that time frame where we saw the plant closures and disruptions there, we will see a pullback in trade. These numbers will not look as good, as simply there wasn't the production there to be exporting. Not a demand issue in terms of whether it's market access or foreign consumers wanting the protein. Simply, the product was just not there. And at the same time, we could very well likely see some increases in imports come through during that time period, essentially what's going on right now. But as we get past these production restraints, we are, again, pretty optimistic in terms of exports that we can return to a trend similar to what we saw previously. I mean, as you think about African swine fever in China, clearly hasn't been a headline maker with coronavirus, but there's still a massive pork gap across the world, and the global need for protein is huge. So we do anticipate that as soon as production returns, that we will continue to see exports perform and taking tonnage off our domestic markets. So as we roll this all together, production, taking out the balance of trade, and look at total red meat and poultry consumption in the United States on a per capita basis. As you can see, the red bar on the right for 2020, we do forecast that net supply will be lower than year-ago levels. We dropped that down by about 5 pounds per capita compared to what we forecast before COVID. So in terms of supporting values across the protein complex, the supply side of the equation on an annualized basis, a little bit more favorable than we would have otherwise anticipated. So flipping the script to the demand side of the equation, as we went through March and into April, and then here in May, we saw where a significant portion of the United States was under a stay-at-home order. This clearly decimated food service, restaurant demand, and we continue to see that restraint today. We did see a jump in retail demand as consumers were still looking for meat and to fill those diets. And there's certainly plenty of pictures floating around of empty grocery store shelves. But as you consider the complexities of the supply chain, recognize that we did a tremendous job in terms of diverting all that restaurant business and getting it to the consumer through the retail segment. We've certainly seen where prices have begun to increase just due to those tighter supplies that we're still seeing currently. But nobody, grocery stores have not gone empty. People have not gone hungry and lacking meat as we have gone through this. So clearly, unemployment has spiked. Incomes are down due to people, due to layoffs, and this will be damaging to at least some degree to demand, to beef or to really anything across the spectrum of the economy. But again, the American consumer, the American economy is amazingly resilient, and it will recover. The question is just, what does the recovery path look like, and how quickly can we get there? Today, as of today, all 50 states have announced at least some degree of loosening of the stay-at-home orders. So again, we do see this positive trajectory is beginning to take shape. So this is clearly a pretty busy chart, but I think it's pretty useful as we look to really gauge what do we anticipate for beef demand. This is simply the year-over-year percent change in wholesale beef demand, so at the cutout box beef level. And you can see what I have circled there on the right-hand side is what the futures markets were anticipating for demand in early April, as the futures complex was making its low, anticipating roughly 27% drop in demand across the bulk of 2020, which actually pretty neatly coincides with a lot of those forecasts for GDP contraction here in the second quarter. Some of those estimates of roughly 25% drop in GDP. So as we look at how these things have been affected in terms of the beef supply chain, clearly restaurant business has been down, as you can see in the top chart there. You have the QSR, the quick service restaurants, your everything from the McDonald's and Wendy's to the more fast casual chains as well. And then FSR, full service restaurants, you could see taking a significant hit, your white table restaurants, roughly 80% drop in sales compared to year-ago levels. Now we do see that all across this segment, across the restaurant industry, things are on the right trajectory, but recognizing that again, it's an uphill battle in terms of gaining that demand through that segment back. But again, retail, huge spike, and this chart, the second chart here, shows both the dollars growth and the volume growth through grocery store meat departments compared to year-ago levels. So again, where we've been able to move a remarkable amount of that product, divert it from closed restaurants, and move that through the retail segment. So just taking a quick look across, taking a look at milk, another place where you can see some of these disruptions taking place. Again, the cheese demand and milk demand from restaurants clearly evaporated milk prices, let alone all those supply chain disruptions that led to the dumping of milk. Also recognizing that these dairy producers, prices at these levels are significantly below those break-even levels, roughly $16 to $17 per hundredweight for milk. So taking a look at the broiler segment, top chart shows boneless, skinless chicken breasts, and the bottom chart, jumbo wings. And so you can see the dark red line in here. You can see the bit of the rally as we hit that consumer, the consumer was hoarding, and we had that rush to grocery stores as these lockdowns first began. And then clearly the huge dip in price as we really saw that hit to the food service industry. So again, as you can see, prices at these levels, boneless, skinless chicken breasts have come back to some degree, but the wings remain severely depressed. And so we can anticipate that, again, it's these low price levels and lack of profitability that signaled the poultry industry to dial back production. This chart now shows the daily USDA pork cutout, so wholesale pork prices. Again, you can see the rally that we saw originally as the consumer rushed the retail case, stocking up on food as these lockdowns began. But even though that was a pretty significant rally to the pork cutout, still roughly kept us pretty comparable to year-ago levels. We did see, as the food service demand evaporated, pretty significant drop to pork prices, and then we see the supply-driven rally as we're not so much pulling on the demand lever, but you're dialing back that supply in a significant way, and we can clearly see how prices respond. So flipping the script to beef, and the being the factor that most of us are all very aware of in terms of hearing about wholesale beef prices, well north of $400 hundredweight. Again, so we can see the consumer hoarding rally as these lockdowns began, being extremely outweighed by the rally that we've seen as supplies have been severely constrained. And as we look forward, again, as we get those fed kill levels back above that 500,000 head a week, do expect that there's risk down into that red box to see a cutout around that $2 level. And then as we look down the road, it will be a true challenge in terms of consumer demand. And that will be the real question. As we, again, saw that hit to unemployment, damaged incomes, and then still see food service and restaurant business constrained to at least some degree. But, and then also recognizing that as we look compared to pork and poultry, we are still priced at a significantly higher price point, which does put us at risk to a price-sensitive consumer. Now, the positive side of this, obviously, is do you think about what we've done as a cattle industry over the last decade since the last recession? I think we need to recognize the amount of quality that we've added into our product over the last decade. So certainly the higher price point does put us at more risk, but again, I think the consumer does certainly feel like they're getting more value from beef. So I think as we look back on this event, as we look back a year from now, we may be pleasantly surprised in terms of how beef values hold up, in light of the economic circumstances that we're seeing. So this chart shows the Kansas daily fed steer price, looking back a decade plus. But if we hone in the black box on the right-hand side, looking at the last 5 years, essentially pretty well range-bound, between $1 and $1.30. And as we look forward and think about that cutout breaking to around $2, but likely being supported around those levels, we do anticipate that if we do, that cattle should be supported near that dollar mark as well, even accounting for historically large packing margins. We have seen cattle trading this week at around that $1.20 per hundredweight, a pretty significant recovery compared to what we've been through in just the last month. But as we look down the road, we do anticipate that as we see the cutout come down, as we see production come back online, pressuring those beef values, we do recognize the risk to cattle values as well. But again, with a cutout near $2, do anticipate that cattle should be supported near that dollar range. So taking a look at the futures side of things, and what this chart shows is the weekly live cattle strip, which is an average of 12 months worth of contracts, so 6 live cattle contracts. And so as you see, we took the market was anticipating at its worst an $85 average over the 12 months ahead, 85 cents a pound. And then as we look forward today, we've added roughly $20 back to that. So as we, certainly not a price that we necessarily like as we would have expected coming into the year, but all things considered, the market is certainly pricing in a degree of optimism compared to what we would have compared to what the market was anticipating roughly a month ago. So taking a look at the fed cattle side. So this chart shows two estimates of break-evens. So where fed cattle are breaking even at, the price they need to get to break even in purple and green. And then plots that against the actual fed price that we saw in black. And then on the right-hand side, what the futures markets are anticipating today as we look forward through the bulk of the year. Now you can see as we look out towards the second half of the year, we are getting where futures are pricing in that optimism that is getting things back to near a break-even level and should offer the cattle feeding segment an opportunity to at least hedge in a break-even, which as we compare that to some of the losses that we've seen over the last several weeks and the last couple months, a break-even doesn't look too bad by comparison. But we do recognize that there is a large gap here right in front of us between break-evens and what the futures markets are anticipating. So do certainly recognize that there are probably some losses ahead of us as well. As we flip the script and look at feeder cattle prices, this is looking at the CME Feeder Cattle Index. So basis, essentially a Central Plains average 800-pound feeder steer. And as you see, taking a look at the black line, feeder prices have, again, appreciated over $10 from their lows that we saw in early April. A lot of that, simply due to removing some uncertainty out of the markets, getting past those lows in the futures complex as everything was in a risk-off environment. And then the red box here outlines roughly our expectation going forward for feeder cattle prices. We do anticipate that we should get to at least some degree that normal seasonal increase through the summer months. As far as where we find our high, ultimately it will depend on, can we build more optimism in the futures complex? Can we get the deferred live cattle to a higher level, or do we see them tread water where they're at, or does the market begin anticipating something worse than what it is today? But we do anticipate that prices should trend higher, simply due to in a big portion due to the fact that these feed yards behind the front end supply of cattle, there's a lot of empty pen space, and so can anticipate that those year-to-date placements being down roughly 1 million head will support feed yard demand for feeder cattle through the summer months. So taking a look at calf prices now. As you can see, it's been a pretty flat market here for the last couple months during that time frame where we tend to see our seasonal highs in the market. But clearly with the collapse in the futures complex and all the uncertainty, that's not been the case this year. The red box outlines our expectation going forward, and recognizing that there's a lot of moving parts here. I think you can make the case for prices being better than the red box, being better than year-ago levels, 2019 last year being the line in the blue, which as we came into 2020, we were firmly anticipating that calf values would remain mostly above year-ago levels, would be better better than last year. But clearly, with the situation at hand, uh, we anticipate that hopefully we should be able to get calf prices to near year-ago levels, but also recognizing the risks that are out there today that if things do not go as planned and as we hope they unfold, could be risk lower than that red box as well. But that is roughly our expectation there today. So should be roughly supported above that $1.50 mark on a U.S. average basis. Now this chart shows the ratio between steer calf price and the feeder weight animal. And so as we start looking forward and start thinking about those summer video auctions in particular, where we'll really see that first test on the calf market for the year, I think that's where this tool really comes in handy. So we've seen the feeder market, basis the futures. The feeder market has gotten up to roughly 140 now for the fall contracts. Now, if we go ahead and assume essentially a 10-year average ratio between those fall feeders and calves, call it a roughly 10% premium. So at $1.40 and add in roughly 10%, gets you to the low 150s mark, the low to mid 150s. So as we think back to this chart, roughly last year, that's roughly into the same range of a 154. So anticipating that if we can get values back into that area, that would suggest that all things considered, that may be presenting a decent case scenario, considering all the negativity and potential downside factors out there. It's certainly anticipate that if we do see more optimism built into the futures as we continue to open up the economy and things go well from that standpoint, you could see even more support during those summer video auctions. And then also, as we look into towards the end of the calendar year, we always like to say that certainly hope is not always a good strategy on its own, but as we look on towards 2021 and see continued improvements in the economy, again, more and more optimism built into the futures complex, you could see some upside potential into the very end of the year and on into early 2021. But again, recognizing that with the demand destruction and all the amount that we've gone through in this industry, if we can get near year-ago levels, does seem to be a good case scenario, all things considered. But as we look forward to the beef cow herd, this chart showing the annual beef cow inventory, we do recognize that we will likely see some more liquidation here this year. We did see liquidation last year with coming out of the plant fire, seeing calves selling again near that $1.50 mark on a U.S. average basis. And if we see prices again towards those levels, could likely see some further liquidation here this year. A few other thoughts. Taking a look at the drought monitor, you certainly see the upper map shows the most recent update, and then the bottom left, year ago, you can certainly see a lot more color on this year's map through the Four Corners region into western Kansas, the Oklahoma Panhandle, and into the Texas Panhandle, as well as off the West Coast. So certainly something that we'll be monitoring as well, and something that as we look towards the fall calf market, if we don't see a decent winter wheat crop, and decent wheat planting through a lot of those wheat regions of the Southern Plains, could see some hampered demand for calves there as well. So something that we'll need to continue to keep in mind and monitor. And certainly plenty of forecasts out there questioning whether this could be turning into an La Nina pattern, so that will be, that continued dryness that we'll need to monitor. Taking a look at corn, the latest corn report showed the 2020-2021 estimate for stocks to use above 20%. Simply put, there's plenty of corn out there, and likely to keep the large supply, keeping corn in the low $3 range. So as we look towards risks to calf demand, certainly won't be corn in terms of high feeding costs, like we were concerned about this time last year with the record slow planting pace. And then quick note, this shows crude oil prices. We've certainly all heard about, prices can never go negative until coronavirus and a few of the technical factors to this market. But the bottom line here, as we look at costs to our industry, don't anticipate that crude oil, that energy prices should be a threat. Even though they have come back a little, certainly maintaining in a reasonable, manageable range. Although from a consumer demand standpoint, would like to see oil prices a little bit higher. And with that, thank you for your time, and I will pass the controls over to Tanner Ahearn.
All right, I think I'm working on getting set up here. Should be good to go. Like Patrick said, my name's Tanner Ahearn. I'm going to walk through some of the cow-calf survey data that we collect each year. But first off, I wanted to start off with some important news that was released yesterday from the USDA. They finally came out with their specs and what they're going to give for the coronavirus food assistance program. I'm sure a lot of you have probably heard about this in the last couple of days, but just want to make sure everyone's aware. They begin accepting applications on Tuesday, the 26th. So if you haven't done so already, I'd start getting your paperwork filed, check with your FSA office. It should help you with that as well. The eligible livestock is for cattle that were sold from January 15th through April 15th. And then they receive this first rate of payment on a per head basis. And then the cattle that you have on inventory from April 16th to May 14th will receive the second value on a per head basis. Now there is some limitations on this program. It's capped at $250,000 per person or entity. However, there are some differences around that. If you are a corporate entity, you may receive up to a maximum of $750,000, depending on the number of shareholders in that entity. There is no adjusted gross income eligibility limit for people or legal entities if 75% or more of that gross income comes from farming, ranching, or forestry. And then these links here would be good sources to go to if you have any questions or need any more details about that program. I would definitely recommend writing these down and checking them out. And then, of course, going to your local FSA office as well. They should be able to help you out. So, I mean, as cow-calf producers, you may not have sold cattle in that first time period, but I'd definitely be taking advantage of this second program here. Even if you get $33 a head per cow, and if you calved during the first few months of the year, definitely try to get some funds for that calf crop as well. Same deal with stocker operators, etc. Even though you may not have sold cattle during the time period the way this market is set up, it'll continue to linger on for several months. So make sure that you take advantage of this program. So what does this mean to the market? Obviously it's not going to make everyone whole or make up the differences that they lost due to coronavirus, but it should definitely help. Nothing is, or this is better than nothing, that's for sure. Patrick showed a chart on the profitability for the fed cattle segment. You can see the amount that they're going to receive for those cattle sold from January through April or through the mid-April. That'll help make up some of that difference, and as a result, put more money in their pocket. And that should be supportive to the calf and feeder market going forward. Just help put a floor to some degree on those markets. So definitely a positive, and recommend taking advantage of this program. Quickly, just going over the summary of this cow-calf survey that was sponsored by Crystalix. We appreciate their support from this last year. The average cow herd size is about 400 head, definitely larger than what you see for your U.S. average herd that the USDA will report. I think our sample here is a good representation of those producers that try to truly make a living off of their cow herd or rely heavily on that income. Your cow costs were basically steady at around $601 a head. Seen that same price the last few years. That is strictly cash cow costs. The calf revenue, it was down about $20 a head. And if you compare that to the CattleFax calf prices, those prices suggest that the revenue should have seen a lot bigger reduction. I'll show a slide here in a few minutes that'll show why we probably did not see as big as reduction as prices might imply. And then obviously, if lower revenue, probably going to have lower prices. Weaning weights pretty much steady with a year ago. Here's just a glimpse of the regional cow cost. Not a lot of changes. Once again, the Northern Plains saw the highest prices, typically have higher feed prices. They also had a tough winter and spring last year. And then your Southern Plains and the Southeast, once again, had the lowest cash cow costs. On the flip side, they typically have cheaper feed costs as well. Each year we break down the producers into high return producers, average, and low return producers, strictly based off of profitability from cash cow costs and then calf revenue. That's what this chart at the top is showing. And then here's just the price, the cash cow cost for those respective groups. So if you adjust those costs for the calf crop percent, have that revenue and cost spread out amongst the herd, even if they did not wean off a calf, you can see we got to add some dollars to each group. $50 for the high return, up to $100 for the low return. And then if you add in a assumption for return to management and depreciation, we went with $125 here. That can obviously vary drastically from operation to operation. Depends how much you want to pay yourself and what your depreciation looks like. But using a $125 assumption, that would put your break evens here in the last column. You can see the average return producers. We'll see a lot of break evens in that 130, mid 130s up to around 150, 155 or so. And honestly, probably don't have a cost changing a whole lot this year. So we'll probably see similar break-even levels again for a lot of producers. With that said, and some of the calf price projections that Patrick went over, there is risk that margins could be pretty slim again for the cow-calf producer, and unfortunately, that could cause some liquidation within the industry as well. But hopefully we can get things turned around and see better calf prices this fall. So how do high return producers set themselves apart from the other two categories? They don't sacrifice these four important qualities: animal health, nutrition, genetics, and marketing. And those top three have a big impact on the single most important economic trait, and that's reproduction or fertility. It's pretty hard to sell a calf if you can't get the cow bred. So definitely keep these 4 bullet points in mind as we go through the next few slides. This is a pretty good representation of what to represent fertility or reproduction within a cow herd. It definitely has some other factors playing in it as well, but we've broken down the calf crop percent or calves weaned per cow exposed based on your producer returns. And you can see the high return producers are simply more efficient, and that's definitely a variable that's pretty critical in production ag. How can you become more efficient, have a greater return on your investment? And you see your low return producers consistently 3 to 4 percentage points behind those high return producers. Here we're looking at a similar deal, looking at calving length sorted by producer returns. You'll notice that your high return producers, almost half of them calve within the first 45 days of the calving season. And over roughly 80% of them calve within the first 60 days. And then to no surprise, as you go further on down the line, you'll see more and more average and low return producers. So one benefit of this is, you create a more uniform calf crop. It should improve the marketability of that calf crop. And then more importantly, it gives your cows more time to recover and breed back, gives them, time to potentially have at least one estrus cycle before they're expected to breed again. And I think this kind of shows this pretty well. It's calf crop percent sorted by calving length. And the tighter your calving window is, the higher your calf crop percent is. Obviously, this is not easy to achieve, to tighten up your calving length. Maybe if you are 60 days, 75 days or more, maybe you try to tighten up your breeding season or cull some of those cows that are bred later in the year. Obviously, if you do this, you'll probably have to have more replacements. So in the short term, there is some cost associated with it, some growing pains, but down the road, it should be worth it. You can see here, should improve your weaning weights, give you more pounds to sell, should be more dollars in your pocket. As we look at weaning length, some of the different practices that producers utilize, I think this is a chart that represents why we saw only a $20 per head decrease in revenue. You notice we had an increase last year in the number of producers that weaned for over 45 days, reduced the number that shipped right off the cow, reduced the few that weaned for 28 to 45 days. And this group here had the lowest year-over-year reduction in calf revenue or calf prices, only about $20 a head. Whereas you look at some of these other categories, it's anywhere from $30 to $25 a head. So if you just think about the typical seasonality of the market, 8 out of 10 years, you typically make your lows in the fall, recover into the end of the year. So that alone suggests that maybe your calves could be worth more. 8 out of 10 years, not a guarantee every year, but pretty good odds there. Now, obviously, as you wean your calves, you should shoot for 45 days or more. You may not put a lot of weight on those calves as it's a stressful time period for them. But nonetheless, it should get them straightened out and improve the demand that they have. Just a quick overview of what the industry does as far as retaining ownership. We saw a few less producers sell calves right off the cow and saw more retain ownership. And, if you think about the market trends last year, it sure makes sense why people did that. And it may be a lot of people may consider that again this year. And if you are thinking about doing that, you need to have a plan to whether you're going to background them or feed them all the way out. Retaining ownership is not a form of risk management, but it could is the key word, potentially give you an opportunity to be more profitable, but no guarantee. So just make sure you're planning ahead and have a, that way then you can capitalize on that plan when time comes. Quickly looking at what the different vaccination protocols are for the producers that took the survey. First off, I want to point out that we had very few say that they do not vaccinate their calves at all. So I think that's a testament to the progressive producers that did participate in the survey. But you can see about 2/3 of them vaccinate at branding, have about half at prior to weaning and at weaning, and then about 30% give a booster after weaning. And obviously they can vaccinate multiple times throughout the year. And there is definitely a correlation in calf value and the number of times you vaccinate. Here's about an $85 head difference between 0 rounds of shots versus 1. Once again, there's about an $85 a head difference. Obviously, there's probably some other variables influencing those calf prices, but nonetheless, I don't think it's a coincidence that we see this positive relationship between the calf value and the number of times that they are vaccinated. Anymore, if your calves aren't vaccinated, you're going to receive a heavy discount. Buyers basically expect them to be vaccinated. That's pretty much a standard nowadays. You're not necessarily receiving a premium for giving them multiple rounds of shots. You're just receiving a heavy discount if you don't. So due to time constraints, I'm going to skip through the last couple slides here, and I'm going to change hand the controls over to Dr. Brett Terhar from Elanco. Once again, we appreciate their support and their sponsorship on this for this webinar. And before we get started, if you have any questions, don't forget to drop them in the chat box. So with that, I'll turn it over to Dr. Terhar.
Hey, thanks, Tanner and Patrick, for those timely insights on the calf market. Elanco is really happy to partner with CattleFax on getting this information out to everybody. There's a lot of unknowns to consider. We've seen a whole bunch of them tonight from Tanner and Patrick. When we look at marketing this new calf crop later this year, the feedlot sector is experiencing some really difficult times right now. Harvest capacity is significantly less than normal. Bids are tough to get on finished cattle on their show lists. And we had a large backlog of finished cattle that occurred really rapidly. So there's a lot of evidence that we could see some difficulty looking forward in calf prices. The feedlots are going to be careful when they come back to reload, I would imagine. I'm not an economist or a market analyst. I'm a veterinarian, technical services veterinarian with Elanco. So just some comments. You can see on the screen here just some of the products that is in the Elanco portfolio. But I heard tonight hope is not a good strategy, and so a good business manager, hopefully you'll take as a good business manager, hopefully you'll take time to look at the available options you have out there. There's a lot of them available. Maybe spend some time looking for marketing options that you may have thought maybe not doable in the past. There may be some opportunity in the timing of selling the next calf crop. As we saw, there's a chance of some poor prices this fall, which is when many of the cow-calf producers sell their calves. So if you've traditionally not weaned calves at home, and we saw that made up a significant percentage of the producers, but they essentially weaned the calves on the truck as they were leaving. Some preparation this summer may give you some marketing choices this fall. For the last number of years, we've seen some really nice prices paid for some heavier cattle, some 7-weight cattle that have been long time weaned and vaccinated and ready to go to the feedlot. They're low risk cattle, especially when you compare that to a balling 5-weight calf. So some of my comments are aimed at thinking about backgrounding your calves, maybe for the first time for 45 to 90 days. So what are a couple things just to think about? Well, preconditioning, we've talked about that already. This is usually something we do generally for the next owner down the line. We hope we get paid a premium or don't receive a discount for by not doing it, but we hope we get a premium for our efforts. So if you feed your calves an extra 45 to 90 days, you may be the one that really benefits from having preconditioned your calves, because you'll have them during that higher risk time. But maybe you could have sidestepped some fall slump prices. Done correctly, there's a lot of weight that can be gained on your calves in a relatively short amount of time. You just have to do some planning. So preconditioning is one thing to think about if you haven't done it before. Again, a plan for when and how to wean calves, whether that's in a traditional dry lot situation, fence line weaning. There's a lot of different ideas out there. I encourage you to explore those if you haven't weaned on your place in the past. For this to be a success, some planning is going to need to occur, but it will pay off. You've got the whole summer to prepare here. And in the end, you may decide not to feed your calves. But you won't be able to if you don't prepare now. So having some preparation in place so that you can make a choice later on is going to pay off. Another thing to look at is building or upgrading your facilities or repairing facilities to allow backgrounding of some calves. You may not have done it before or not for a long time. Again, you have the summer to make sure you have the facilities that allow you to feed calves for an extended period of time and maybe sidestep some market lows here at the end of the year. The other thing to consider is feed supplies for weaned calves. Again, it's going to take some extra hay. Maybe you've got the ability to do some grazing. You'll need to think about some grains or concentrate mineral programs, some of those things. Again, it's planning. And then the last thing may be financing. Talk with your banker ahead of time. Do that this summer. You don't want to try and figure things out right at the last minute in the fall. To that end, and to help with all these, Elanco really, we've got a good team of sales professionals and technical people that are available and willing to help with all your animal health and management questions. Beyond that, Elanco has a number of products to help get all the performance you can out of your calves. I'll just mention a couple here to finish up. Rumensin, a feed additive that has been around for many, many years. Just about every animal in the feedlot sees rumensin, not used near enough at the cow-calf level, but in a high roughage diet, you can see some amazing increases in average daily gain on the cow side, but also at the calves. If you haven't weaned calves for a long time, you really want to think about this, not only for the increase in average daily gain, but coccidiosis. That can really spoil or take all the fun out of backgrounding your calves this fall if you have a coccidiosis outbreak, and rumensin is a super way to do that. Another thing to consider is the component implants. So implanting your calves this spring is a great thing to do to increase weight gain, and then consider doing that in the fall when you background these calves, whether it's on grass or in a dry lot. That is a great return on investment. You can see 12 to 16% increase in average daily gain. Great tool to use this fall. And then vaccines. Certainly we've got the titanium virus shield, Nuplura line, a number of vaccines. Prevention is really important. It is a lot cheaper and more cost effective than treating animals. So feeding calves this fall may be a profitable choice. Again, make some preparations so you can choose whether or not you do that. So the idea with the products from Elanco is making every day a good day for your calves. And with that, I will turn it back to Tanner. Thank you for your attention this evening, everybody.
Yeah, thank you a lot, Dr. Terhar. And if anyone has any questions for him or wants to get in contact with an Elanco rep, just shoot myself or Patrick an email. We'll forward your information or get you in contact with an Elanco rep. And if you have any questions or anything, we'll be sure to pass those along. We greatly appreciate Dr. Terhar taking the time out of his evening to join us, and greatly appreciate Elanco sponsoring this webinar over the last several years. We do have a question here that's asking about, we mentioned that packing plants are running about 75% capacity currently. And if we do incorporate different social distancing protocols, will we ever get back to 100% capacity this year? I think that question right there is definitely a challenge and a risk for the industry. We have heard of different plants and implementing, whether it's shields between the workers or spacing them out more, that in theory will likely slow down the production line, the efficiency of the production line. And so that is a risk that we definitely have, that we never make it back to 100% capacity this year. Now, we have, in our forecast, we have assumed that we will run at 95% capacity starting around the 1st of July. So even if we're running at 95% capacity, we still think there's a pretty good chance we can work through that backlog of cattle by the end of the year. We'll probably end up backing up about a 1.2 to 1.3 million head by the 1st of July, or at least by the 1st of June, I should say. And then, but because of that huge placed against hole, with placements being down a million head, we could still be able to work through that backlog, even if we are running at roughly 95% capacity. So with that, if you have any other one-off questions, send myself or Patrick an email, and we'll be sure to get back to you as quickly as possible. Don't want to take any more time out of your evening. We appreciate everyone joining us, and we'll look forward to doing one of these again in a few months. So thanks again for joining us, and have a good evening.